All right, today we're jumping in and decoding the market pressure EA. It's a trading algorithm that's built to solve one of the most frustrating problems any trader faces. So let's pull back the curtain and see how it really works. You know the feeling, right? Price smashes through a key level, you jump in thinking this is the one, and bam, it reverses on you. It's a false breakout, a fake out, and you're trapped. Well, this algorithm was designed specifically to try and solve that exact problem. So here's the game plan. We'll start by really digging into that trader's dilemma. Then we'll introduce the core of this system, the market pressure score. After that, we'll break down how that score is actually calculated, how it triggers a trade, and finally, how it all comes together with risk management. Okay, so let's start with that fundamental challenge. A breakout on a chart, well, it's pretty easy to spot. What's not so obvious is the real power, or, the total lack of power that's actually driving that move. Exactly. Spotting the breakout isn't the skill. The real question, the million-dollar question, is whether that move has real conviction. Is it a genuine shift in the market's mood, or is it just a bit of noise? This algorithm's entire purpose is to try and put a number on that conviction. So how does it do that? Well, the algorithm's answer is something called the market pressure score. You can think of it as a way to quantify that constant tug of war between the buyers and the sellers to see who's really in control. Put simply, it's a custom-built running score that tells the algorithm just how bullish or bearish the market is at any given moment. What's interesting is that it totally ignores traditional indicators. It's not looking at RSI or stochastics. It's focused only on the story that the price candles themselves are telling. And to build this score, it doesn't look at the whole chart. It looks at a very specific window of time, the last 20 closed price candles. This gives it a really fresh, up-to-date snapshot of the market's recent mood. So how in the world does it turn those 20 candles into one single actionable number? Let's decode the logic. It's actually a pretty fascinating three-layer process. The logic kind of builds on itself in 3 steps. First, you've got the basics. A candle makes a new high, you get +1. A new low, -1. Simple enough. But then, layer 2 is the trap detector, and this is where it gets smart. If price makes a new high, but then closes weak, the algorithm sees that as a fake out, a trap, and it flips the score to -2. Finally, step 3 adds what it calls a conviction multiplier. If a candle is big and powerful, its score gets doubled, giving those strong moves a lot more weight in the final calculation. Okay, so we have a score. Big deal, right? A number is just a number until you actually do something with it. So let's look at how the market pressure EA translates that score into an actual trading decision. Now, this isn't just a simple on or off switch. It's way more nuanced than that. As you can see here, a mildly bullish score, something just over 1, will trigger a single buy trade. But if that conviction gets really strong, if the score hits 15 or more, it'll actually scale in with up to 3 positions to really try and capitalize on that momentum. And of course, the exact same logic applies in reverse for sell trades. So what about getting out of a trade? Well, the main exit strategy is tied directly back to that score. When the market pressure starts to fade and the score drops back into what it calls the neutral zone, that's between -5 and +5, the algorithm closes out the position. Now, it's really important to note, this feature only works if a specific setting, close on neutral score, is actually turned on. And of course, no strategy would be complete without talking about risk management. You have to have a safety net. The market pressure EA has a pretty flexible system for protecting capital that actually blends both dynamic and static rules. So you basically get 2 choices for how you want to set your stops. The default setting is ATR-based. Now, ATR just stands for average true range. It's basically a measure of market volatility. This means your stops will automatically get wider when the market is choppy and tighter when it's calm. It adapts. The other option is to use a fixed number of points. It's definitely more predictable, but it's just not as flexible to changing market conditions. On top of that, the system has another really clever way to protect profits once a trade is in the green. It's a trailing stop that can be set to kick in automatically once you hit a specific profit target. And here's how it works. Once that $2 profit target gets hit, the trailing stop activates. From that point on, it automatically moves up to lock in 50% of any of your floating profit, while still giving the trade enough room to hopefully keep on running. It's a great way to protect your gains. So let's just recap the core ideas here. First, this is not your typical breakout system. Think of it more as a pressure and trap detection system. It uses that unique multi-layered score to actually try and quantify market conviction. It also scales into positions depending on how strong that signal is. And finally, its risk management is really flexible, using both those adaptive and fixed rules. And all of this brings us to a bigger, more philosophical question, doesn't it? This whole system is designed to take complex, emotional price action and boil it down to a simple, objective score. It's about replacing gut feeling with hard rules. So, in the chaotic world of trading, is a system like this, one based on rules, ultimately more reliable than human intuition? Something to think about.